Welcome to the Anti-Money Laundering and Counter-Terrorism Financing course for accounting and professional service companies. This course is designed to provide you with an introduction to potential money laundering and terrorism financing risks that you may face in the normal course of business. The contents of this course includes learning objectives, an overview of money laundering and terrorism financing, an overview of the main stages in the money laundering process, including placement, layering, and integration techniques, an overview of how money is laundered through the accounting and professional services sector and case studies, red flags, and a learning assessment. In simple terms, money laundering is the process that criminals go through to disguise the origin of illegally obtained money. There are 3 stages in the money laundering process: placement, layering, and integration. Terrorism financing is generally defined as the act of providing financial support to terrorists or terrorist organizations to enable terrorist acts to be carried out. Terrorism financing does not necessarily involve illegal funds. In fact, it often is carried out using legitimately obtained income, and in many cases involves relatively small sums of money. The types of complex corporate and trust structures that accountants are known to have set up to commit money laundering offences include companies owned by several other companies, where the ultimate beneficial owners and controllers of the parent and subsidiary companies are more difficult to establish; trusts, which are set up solely as investment vehicles but do not operate an active business or service; private investment companies, established for the sole purpose of parking funds; shell companies, which have been formed but do not have any significant assets or discernible business activities; and companies established in offshore banking centres in tax haven countries. The following fictitious case study demonstrates how a person may use an accountant to facilitate a money laundering offence. Mr. Juan Dodgy Guy, a notorious drug trafficker, employed in the services of a newly qualified accountant to complete the conveyancing on the purchase of several bars and nightclubs. The accountant, on the instructions of his client, established 10 different trust accounts, where funds were transferred from Mr. Guy's associates over a period of several months. The accountant, also on the instructions of his client, facilitated a number of structured payments to repay significant proportions of the outstanding mortgages that had been secured against the bars and nightclubs, as well as purchase a stake in an upmarket restaurant. The accountant also arranged to purchase property for relatives and business associates of Mr. Juan Dodgy Guy, even though the accountant had not met them personally or had any dealings with any of them. Finally, the accountant, whose girlfriend worked at a prominent investment bank, advised Mr. Guy of some hot share tips and received further structured payments into the trust account for which to place an order for 10,000 shares. What red flags did you notice? There are a number of red flags in this scenario, including: why did Mr. Juan Dodgy Guy instruct his accountant to open 10 trust accounts? And what was the reason behind funds transfers being made by third-party associates of Mr. Juan Dodgy Guy into these accounts? Why did the accountant structure repayments of the mortgage in a way that was intended to avoid reporting?